You're watching Master Trader Live, simple market analysis and education to help you make money in the markets. Join us live each week on YouTube and see past episodes at Master Trader Live. And now your show hosts, Greg Capra and Dan Gibby.
Welcome everybody. We're here another Wednesday, Master Trader Live, and today we're going to be talking about the benefits of buying and selling options over stocks, meaning instead of stocks. Yes, that's what we're going to be talking about, and we're going to cover starting out with some basics and building up to how to use this information, which is what we do every single week. We provide you with basically, well, I wouldn't call it really a snippet of information because it's actually pretty vast, the amount of information Dan and I cover in 1 hour. Maybe some have referred to it as drinking from a fire hose at times, but look, our intention is to over-deliver and to provide you as much education as we can within that 60 minutes that we're here with you. So I'm not going to waste any more time. Options can seem complicated. I wouldn't say seem, they are at the beginning. Some of the terminology is new to us. I know it was to me when starting out and what the meaning it is and how to interpret that, but they offer lots of options on how to profit in the market. So let's get going, Dan.
Good afternoon. Yeah, you said that exactly right, that options provide options, and we're going to discuss that. And just to elaborate on that, why is this called the benefits of buying and selling them over stocks is because stocks don't give you options in the sense of a three-dimensional creation of a trade to mimic your bias of the underlying. For stock, I say it's one-dimensional. It's like a car, with a forward and a reverse without a steering wheel. You go long and you go short and you profit 1-to-1. So this is our technical approach to trading anything that moves. Price is king. Combination of those gives us high probability trade setups that we then add these other concepts of ours. Where is this pattern? Where is that pattern in connection with the overall trend? Support and resistance, multiple time frames are so important. Sure, we look at volume as a secondary bonus, if you will, like on igniting and reversal patterns. What are the broader markets doing in the sectors? Is it showing relative strength or weakness? And then Greg's favorite, all about position and money management. You have a high probability trade. And Greg and I look at it in 1/8 of a second. We say it's a no-brainer trade setup. And then you calculate position size and manage in between.
This is a vast amount of information. This one slide, meaning not on the slide, but what it encompasses and what we really talk about each week to week on an individual concept about what we call Master Trader Technical Strategies, MTS. And so as we put this all together, and Dan, I think, this can be overwhelming initially, I guess, like anything else is that you begin to learn. But as you said, we look at this stuff because we've been doing it for a while and it's become second nature. But I think this is what leads people, I guess part of the industry is that way, but it gravitates them to thinking, whether it's a red light, green light, or some kind of an indicator to tell me what to do, versus what we do here is teach you how to interpret price action in combination with these other strategies. And that comes together as a strategy. So today we'll show you, after Dan covers some of the option stuff, how to put that together with the technicals.
And just another analogy to what you said there is, do you want to go to the gym and eat healthy to lose weight and stay healthy? Or do you want to listen to some bogus marketer say, take my pill and you can eat whatever you want and not go to the gym? So we're showing you the proper way, of course. So basics here, buying and selling call options. We're going to talk about doing both today. First of all, what is an option? It's a contract. You go to the option table and you buy or sell these options, and they give you these rates to buy or sell the underlying stock, ETF, future, commodity, whatever is optionable. And you have a certain time to exercise that at an agreed upon price. And that's what's going to set the price of the option, along with some, Greeks, as they call them, which we're going to not get into today. One contract represents 100 shares of the underlying. So if you are buying a call option, you're bullish. You are going to profit as the underlying goes up in value, because then the value of your contract is going to go up in value. So we call that a directional strategy. Now, we'll get into this later, but now the opposite side of that, the call seller, they're taking that money and they have an obligation to deliver stock to you. Now, if they have it in their inventory, fine. If not, then they got to go to the marketplace and get it to deliver to you if you want it. So that's a bearish strategy. Now, we do that for a couple of reasons. One, when we're speculating on bearish patterns, and number two, it's when we leg into a covered call, which again, we're not going to get into today, but it's another example of the three-dimensional aspect of buying and selling options.
So Dan, just to clarify, you said we're not going to get into it, but we're saying the bearish strategy, it's somewhat bearish because, and what Dan said, if you don't own it, you have to go get it. Meaning, so covered call, meaning I own it, I have it, and I'm still bullish on it, but based on the technicals, I think this is an opportunity for an income stream to lower my cost and put some money in my pocket while still owning the stock. And that's kind of like the 2-sentence overview of what a covered call is.
So call buyers, the benefits over trading stock is we're profiting. We both have a bullish bias, the long stock and the long call. But we are using leverage because of the leverage component of buying these call option contracts, and we have limited liability. Well, we both do, but when you buy stock versus buying a call option, you're going to lose a whole lot less if it goes against you or you have a catastrophic gap against you. I'll get into deltas in a minute. So this is just the opposite now. You're buying a put. Why would I do that? Well, I want to profit from my directional bias of something going down. And so I go to the option table, buy a put. Now I have the right to sell stock. So if something is falling from $50 to $45, and I have a contract that makes that I can sell it back to you at a higher price, the value of my put option is going up in value. So that we buy puts as a directional bearish strategy. We'll get into this later also, but it's here. The put seller. The put buyer thinks something's going down. The put seller is, I don't think it's going down. Like I'm looking at EMPA or run right here in EMPH. So if we have a bullish setup using our strategies, the concepts on the first page we reviewed, then we have a checklist we go through to say, yeah, I'll take that money. I'm going to sell a put or put spread. And we keep that money when we're option sellers. And that's our potential maximum gain. But again, we're going to start with directional trades in this presentation today. Same as before, we're going to profit though from our bearish bias with leverage and limited liability as opposed to shorting stocks. So these are all pictures of bullish trades. And then you take these pictures and on the first slide, you overlay them. And then we decide if we want a directional option trade, or if I just want to sell a put under it, under support, because I'm just calling a short-term bottom, or I'm going to show you an example where we do both. Do both. Take the money from selling the put and go buy a call option. So we're putting on two bullish positions at less price.
So what I just drew there was why are these bullish trades or setups really? So I put a little line there. I mean, maybe it's on some support over here to the left, which could be what we call minor support. It could be potentially a major support, a pullback toward a prior swing. But in any event, kind of just a moving average that we call visual aids. And we're going to be talking about that in upcoming MT Live. You can sign up for that MT Live at the page, the education page on the site. But we think it's going up, and it's pulled back to an area where buyers are going to show up. We've got a reversal bar, and we could either do a directional trade or an income trade, which would Dan had in the prior one, selling puts or credit spread, which I guess we'll get into.
All right, pictures now. Show me pictures. So this was a while ago when gold had a nice run here, a big bottoming pattern, and a little gap breakout. Okay, I want to participate with options, buying calls. Weekly chart here, also a bottoming pattern. So that was multiple time frame alignment. So what do I do? What am I going to buy? Well, so you come to this, and Greg said, wow, this is overwhelming. And it is. You have to take our course and learn what calls and puts are, strike price, the definitions, but I'm going to give you a crash course right now, the best I can in an hour. So gold, so right here, I'm saying gold closed at 161.29. So these are the screenshot of the prices. This one had 29 days to expiration. So I just said on this prior time, what expiration do I buy, Dan? Well, how long do you think you're going to be in the stock is one question. And are you a buyer or seller? I want to be in this trade for a couple of weeks. And when I buy more time, the time decay as an option buyer is not going to hurt me as much. And we'll get into that. That's why we sell short-term expiring options. So delta here just means how much is my option going to move for $1 move in the underlying. The higher the delta, the more money it's going to cost you. Because just think about it. If you have a contract that says gold's up here, I have a written contract that I'm allowed to buy GLD at 122. Well, it's cheaper in the market. So why do I want this? It's leverage and the limited return. So the deeper in the money you go, the price for this contract is going to be more expensive.
Hey, Dan, I got a question.
Sure.
Why is that leveraged? So the delta there being where it is, it's not 1-to-1, but if I buy that call option, I mean, I'm paying a lot less than if I bought the GLD itself.
Right.
But why is it leveraged? I'm asking this question because I mean it's lower priced. I'm buying this option. I know I have to have a margin account to do options, but one option is 100 based on 100 shares. So where's the leverage there?
Well, the leverage is because if you buy 100 shares of GLD here, that's going to be add 2 zeros. That's going to be $12,169. Right. If I'm buying this 70, well, we actually bought this 85 delta one. The midpoint would be 310. So one contract cost me $310 as opposed to your 12,169. So that's the leverage. And the deeper in the money you go, the more it's going to act like the underlying stock. So that I don't know if you're doing it on purpose or not, but that's
no. I'm asking, honestly, because
no,
like if I buy a stock that cost me $3, and it goes up or down. I know there's the time element and how fast prices move related to options, and I know there's Greek terminology for that, but basically I don't see it's not it's not like I'm leveraging my money per se. I mean, I know I'm not buying the underlying here, but it's going to move up or down, with the underlying. So I think the point is, if you understand options, it seems kind of like thing to do. If I can press that button and get filled, again, it comes down to liquidity, but if I can get filled on that option and the liquidity is there as quickly as I can get filled on, buying the underlying, well, then why not do it?
Well, and I was waiting for you to finish, and I was starting to say, I didn't know if you're doing this on purpose, but it's an excellent point of highlighting the amazing benefits of liquid options. Because let's say I buy this deep in the money one, the 118s. So it's $3.69 in the money. I'm only paying $310 for this. Just hypothetically, it gaps down $10 and I lose my whole $3, which I won't because of time decay, but we don't have enough time to teach you an 8-hour course here. So you have lost $1,000 on a bearish gap down if you're long 100 shares. I've lost less than $300. So as long as they're liquid, there are tremendous benefits over trading stocks, the leverage and the limited return. And I'll add a third one there, which is less loss if it goes drastically against you. So those are three amazing benefits of buying options over the underlying.
I just added the midpoint thing concept, $3. I put in $3.10 because while that's kind of spready for $3, that spread, if it's liquid, almost in every time you're going to be able to get filled in between that. Just the point to those that aren't aware of it.
Yeah, at this point in time, this was very liquid. So that's actually one of the reasons why we bought the 85s also. And then, the thing rallied and just hypothetically, I'm not trying to be a Monday morning quarterback. I'm trying to show you how some basics work here. So if you held it for a long time, 26 days, so now you're selling that 119 call, you made over $16. Now, yes, you made that trading the stock also, but if you take $16 divided by 121, your rate of return is, I'm doing it in my head, is 8%. I made 429%, risking substantially less than you do if the thing goes against you. So this is a beautiful example of highlighting the benefits of it. Here's another one, just no-brainer setup, bullish consolidation. So Greg, since we start with page 1 of the concepts, tell us why this is just a beautiful closing breakout of this and why it's a directional.
All right, so several reasons. See, this broke out here, and someone in the chat on the internet there, YouTube, asked me about what a wide range bar is. That's a wide range bar, what we call an igniting bar, because it was consolidating for a while, but it didn't take off right away. And so it went through this consolidation, and one of the concepts that we look for, I don't even know why it works, to tell you the truth, but when prices reach the rising 20 simple moving average, it tends to be a point where they're going to move up again. So it's a way of measuring the time of a consolidation where it reaches the 20. But these dots here, they're pivots. And what we do is we mark our charts with swings, and it's just simply a bar with 3 higher lows to the left and right. And the idea is that it's creating support. And then it came down to the same place again. So it's building this big support point. And we look at this charting from the point of view as what are they telling us about what other traders and institutions are doing. And when it comes down here, and notice this bar here with the pivot on the top, it was a little failure there, a little minor failure. So there's like the psychology of the pattern involved. So that little breakout failure created some uncertainty because, look, at this point, we don't know that it's going to do this, but this little failure here creates uncertainty about, hey, why did that fail after this pattern formed? But buyers are willing to step up again at the prior pivot, and then it comes back up again, and then it just kind of, gets the momentum shrinking there, and then it takes out the high of a red bar.
Yep.
And so this is a beautiful combination of concepts coming together at that moment. Now, if you bought that, you wouldn't have gotten stopped out, because we would teach our students that the stop would have to go under there, and you'd be sitting through this period of uncertainty and, little nervous jitters that you're going to get stopped out. But again, this little consolidation at the top and getting over the red bar, it was just a fantastic setup.
So we bought some over this red bar. Yeah, well, we bought the whole thing there, 230 a share. We bought these calls. I can see that these are in the money because I'm wanting more total dollars from my directional buys. So we go in the money. We only paid $2.30 a share. We sold half actually the day we got in. We sold the back half here, 81% return. It's actually 2 days. The computer's not counting the next day, but it's 81% in 2 days. Here we got a buy set up here. We have, I didn't do the trade here, but I'm just pointing out this would have been a beautiful long call entry also over the high the following day, over the high of this green bar. Now we have nothing really, I'd just be in trail mode. But now we have a beautiful 180 reversal with a 1, 2, 3 continuation. 2 inside bars in the upper part of this, in an uptrend, nothing to the left. This one we also bought in the money calls, $7 calls, sold a third here for 50% return in 3 days. Moved the stop to 831. So we just went into trail mode. I as a general rule, I manage my directional options exactly the same way as the underlying. So
that's what I like about it.
Which is under, we trailed under, well, you see it, we sold a third for a nice gain, and then trailed under prior bars low. Now let's talk about puts. This is a breakout failure with the FAR. Greg said we're going to be talking about moving averages soon. This is exactly when things get extended, particularly with a climactic weekly also. Greg, whether you're salivating on this, we are looking, look how far prices are from the 20 from the 50, 200s down here being hidden here, but that's extended. So we are looking for signs of failure. This is a breakout failure. Gap down, close green. So under the green bars low, we bought puts. Let's buy the 67, and 67 puts were we're actually at the money on this one because we thought this thing had a lot of room to fall, which, as you can see, it did. So you can see what we did here and here. We made, look at this, 68% return in 2 hours. That's insane. And that's not normal. So I'm not here trying to tell you that these are like lottery tickets and you're going to become rich trading options. You definitely have to do it intelligently is what we teach. And then, so we got out into weakness, made over 100% return with a $410 like contract cost basis.
Let me add that we didn't know that breakout would fail. We knew it after the fact. So we're not telling you like, we have a crystal ball here that predicts the future. We know what happens in the moment. And so when this turned red, it could have been followed by another green bar and went up. But when it gapped down like that, the psychology of the pattern was longs were caught. And this could have been related to an earnings announcement. Some empty lives, we talk about market internals. We could have had a signal that the market was ready to make a turn. And so, this thing gapped down, longs are caught. What are you going to do if you were in it? You're going to hit the bid. And so who are those longs? They're institutions. and they were buying this, right, all the way up. It's going up and up and up and getting extended. So they act as a herd. They're all looking at the same things, the same analyst reports and earnings and whatever else they're looking at. So when things don't work and they've all been buying something that's been rising like this, there's a tendency for prices to collapse because they all get out at the same time. And so we're essentially, through our method of technicals, is looking at what these institutions are thinking. What is their bias and what might they do if it doesn't work?
Yeah, just a comment on Don. Every time we have a directional setup that says, yeah, I'm willing to short the stock right here, I go to the option table to see if the options are liquid. If they are, I prefer trading options for the reasons that we're reviewing here together. Here's AM. This was one we did last week, and I'm going to show you a couple of bear call credit spreads. Last week we had was a week ago Friday. We had a nasty 180 reversal all over the place, igniting bars with a price void. This one we did a directional trade. In this one, we did what's called a bear put debit spread, which was buying a put, just like we showed you in the other examples. But we're also selling a further out of the money put to lower our cost of the long put. And we do that when we want to, it increases the probability of profit, and we do it in exchange for capping our gains. So that's what this is. So we bought a 95.86. We went in the money on the 95 puts. We look at the chart and say, okay, how far do I think this can drop for a 2 to 3 or 4 day swing trade? And we did the 86s. We took that money, and the net cost was 420. Selling a 1/3 here for a quick 30% gain, so on and so forth. We got out at 46% in 3 days.
So that little comment box there is what subscribers see to the newsletter.
And the closed trades.
Yeah, so Dan is updating, excuse me, for text messages in real time. And then in the spreadsheet, everything is documented for every trade, the opening and closing prices and the comments.
So here's an example of what the Telegram alert looks like. And the VXX is the volatility ETF. It's a beautiful instrument to short bear call credit spreads. And when you think you have a big gain, or potential, if you have a directional setup, then we buy puts on them. And this is showing you that we bought $40 puts. We did them right here on the gap down and breakdown right here. Bearish gap, sideways, breakdown. We bought $40 in the money puts. Very simple trail just on this little 15-minute chart. I say for day or swing trading. So Don, I'm going to show you a couple day trade examples here. I love day trading options if they're tight, if the spreads are tight. So spiders, Qs, AMD, some of the FANGs, Meta, Microsoft, they're beautiful candidates for day trading. So this one, let's see, we made 55% in 1 day, and you can see here that the net we held at 4 days, 60% return.
Hold on a second there. There was a question about share sizing. I'm going to drop this link in here that we share with everyone. Gets into some of the foundational concepts of share sizing. And so with directional option trades, I don't see any reason why not share sizing it the same way you would the stock. You could possibly increase the size of how many contracts you might do. Again, it's one contract, 100 shares. So, take that into consideration and then share size accordingly to what your your max loss is going, well, your max loss is going to be what you paid for the option. But if you're gonna manage it the way you would the stock, the underlying, wherever your stop is going to be, calculate as best you can where those options would be, and then, do the number of contracts accordingly.
And somebody might be asking, Dan, why are you showing this guy in a windstorm? What the heck does that have to do with anything? It's because volatility options and futures and ETFs like this, the VXX, they have headwinds. So this is my diagram showing you a headwind. And so these are beautiful after the market rally, the market has been selling off and the volatility has become climactic, like a climactic sell setup. And then we use our approach to say, okay, this thing's ready to go down. And it just has tremendous headwinds. If you want to do yourself a favor, go look at a weekly and monthly chart of VXX. Look at a monthly over a couple of years. And this thing just gets beat down because that's the way it's made. Volatility spikes on fear, and then it just has it's because of the way they roll the futures that they're created that way. And so Don, all the day trades pretty much, we give verbal trades all day long. Greg does a lot of them, and we don't send those to Telegram. Here's just showing you an example again of leverage. This was a beautiful late day breakout setup on Amazon before it split, obviously. Buying 100 shares would have cost you $302,000. Other than 4-to-1 margin, I type it here. Buying one call option, what we did, $5,000. Now here's what we did. So we bought 4 days to expiration because even though we're paying $50 for this thing, which is $5,000 for one contract, I'm not worried about the time premium as much for at the money because, Greg, you like to use the 3-bar rule, and when we're day trading, this pattern better go soon. If this pattern, this closing bar, my stop's under here. So I don't know how much of this I would lose, but it's a small fraction of that $50 price that I would lose. Then the next, just into the close here, we sold it 60 whatever dollars here, $1,300 gain, 26% return. You couldn't, not many people can buy many shares of Amazon at $3,000. Here's just another one we did on Google one day. And this one, we did kind of do a little bit of a lottery ticket, intelligent approach, because we bought very cheap out of the money options that were only like $10 away. And Greg, I don't know if you remember this one. You and I were both looking at this, and I said, hey, Greg, we can, for 20 cents, we can buy a call option that expires that day for 20 cents, and it was $15 away or $10 away. You and I were saying, for Google, it can run $10 in 10 minutes. And so that's what we did. So here's a guy in our room here, Cameron, 400% profit. Look, this is just an afternoon day trade.
Yeah. So I had got, someone posted a question in the online thing about what should be learned first part of the learning curve, trading stocks or options. And it's actually neither. What you have to learn first is what we call Master Trader Technical Strategies, which is part of the MTS course or the swing trading course, or what we talk about here, weekly, putting it all together. Everything's put together in the course. But once you learn MTS, you could trade whatever you want. So, learning options is another course or another level of understanding how to trade that particular instrument. But from our perspective, it would be foolish to trade options without an understanding of the technicals And this Google is a prime example. If you couldn't understand the technical analysis of it, it would seem pretty stupid to be buying an out of the money call.
Right.
But based on how we look at the charts, price voids, patterns, failure, patterns, pivots, and relative strength and weakness, and so on, it makes sense that this stock could move at that moment in time. So, repeating, you need to learn the technical analysis part first, and then you could learn more about, options. We're covering part of it today. Are they liquid? What's the spread? Then you got to, of course, you're going to see how you're executing that trade maybe a bit differently than just buying the underlying. So, and I'm saying all of this not to overwhelm you with information, but look, you're learning a business here. So don't think, coming to a webinar for an hour, it's great information, but there's a lot more to learn, including what button to press and how, especially with an options trade, because, you might want to do a credit spread where you have to press 2 buttons and then maybe a third to send the order. But it all comes together, it's part of the learning curve. So, and the first part is learning, how do I determine objectively if the stock is going up, down, or sideways, and what's the likelihood of that trend to continue?
Yep. Every one of these stars are master trader sell setups where you could have bought puts. This one, actually, we did at this third place. And I also called these debit spreads. They're mildly bullish or bearish because we're capping our gains. And so this one, we like the fact that the gap up here got negated. That was a bullish gap. If it took out a 30-minute high, for example, I would have had a bullish bias. But then it traded under the low of these 2 bars, and now I have a bearish bias. It's in a downtrend. So we bought a 230, 220, $10 wide call spread. I'm sorry, we did a bear put debit spread. $3.50 a share. So our maximum gain on a $10 wide is $6.50. It's the difference of the spread less whatever you paid for it. So this one we held for a couple days here and made 61% return. Now let's talk about selling options. Same slide we saw before, I'm just highlighting this one. So the put seller, we're receiving the money for the obligation to buy the underlying. Same with this, we talked about, you're receiving money for an obligation to deliver stock. Going back here, nice gap reversal. We dropped down to a 15-minute time frame. We have a double bottom using the pre-market data here. And so, Greg, I love asking you this question. Haven't done it in a while. But using this, so we had a gap down, big move, retest. Right, I think we put it on, I don't know, right over here, 237. What are the odds of this going all the way back down here? Look at my the 50 MA is right here at 223. What do you think the odds of this going to 225 are now in 2 days?
It could happen, but low.
Sure, but our stop,
see, and I'll explain why. It shouldn't happen is because there's 2 things going on. First, it's at support. It's already pulled back for 2 weeks, and you've got a wide range bar. Now there's resistance here, right? This cluster. So it'll probably, in my opinion, just based on everything I'm explaining, it could be more likely to chop around here. Now, as long as earnings aren't coming out, the likelihood of coming down here is probably pretty slim. Now, directionally, you're going to have to wait for that congestion. I believe that's what would happen. But going down here in 2 days is highly unlikely.
Right. So that was a one DTE trade. So here's one I told you that sometimes we do two trades. We did a bearish directional option trade, and we call selling options income trades. So this is a sell setup at the gap fill, declining 20-period moving average. We bought an in the money 205, 190. So that's a $15 wide bear put debit spread. We give all the reason why: sell setup, reversal at resistance right there. We sold in 3 different lots, and well, I'm not showing you the gain on this one, but you could see the math there. Now let's get into bear call credit spreads. This one, see the 205 right here? We shorted the 205 calls, bought $10 higher, the 215s. That's called a bear call credit spread. 97 cents a share is immediately deposited into our account. If you did a 10 contract, just using math, simple math, $970 is immediately deposited into your account. But remember, our stop loss, because I know, Greg, people ask this all the time, and it is a very good question. Why would you risk $9,000 to make $1,000, Dan? Well, it has to do with probability. Why would an insurance company give me $1 million policy for whatever, for $1,000 a year? It's because they collect all the premiums, and yeah, they're going to have to pay some payouts. That's how the risk curve works on credit spreads. But we had a compelling setup here. We had liquid options. We took in 97 cents. I think this one was 2 days to expiration. Well, no, it was a week. I can see here, 10-1 to 10-8. And then we take our profit into weakness on call spreads. But remember, our initial stop is here. So unless this thing gets bought out and gaps significantly above our short strike, we have never in our career taken a max loss, because we manage them with the charts. A couple comments here, both to our weekly options trader, which it solely takes patterns like that expire 10 days or less, because the Greek called theta, which is time decay, expires rapidly into expiration. So the stock can do absolutely nothing, and we're making money day by day from that. It's like a melting ice cube. So there's some folks.
That's part of why we, we look at SPX credit spreads every single day. And
because it's
got a phenomenal track record with getting those pinned to, not pinned per se with options, but being successful with them probably 99% of the time.
Yeah. All right, so the next couple slides here we can do quicker, and then as always we like to look at some real charts and see if we can find some trade opportunity for us for the afternoon. But all of these is when we had the same bearish reversal a week ago Friday. We started putting all these credit spreads on. And when we nailed the turn, as we call it, either a bearish turn or bullish turn, and that's where our market internals give us, great additional evidence of a turn. It gives us the heads up, but then price action is the action symbol. So every one of these, we found these left and right. So here, the spiders, we shorted a call spread over the high of this red bar. Look at this, close half at 14 cents, half at 4 cents, take your money. The Qs, we did the same, just identical concept. Hilton, big ugly gap reversal, after a gap down reversal in the gap area. It's just, these are no-brainer setups. So this one, we sold the 140s way above here. So we entered on this bar, and the 140s are above the 200-period moving average, and you can see how we managed it and to weakness. Another one, Boeing, we did big topping pattern. You got 2 ugly reversals here. green bar ignored. We shorted this one, $5 wide, 55 cents, closed it out into weakness. I say right here with the bearish gap, let's close into weakness at 16 cents. Take the money, go into the next trade. Last one, UAL, sell setup, ugly wide range igniting under the 20 and the 50. We shorted the same thing. It's 37.41. Closed half at 20 cents, bid 4 cents for half. That's it. So on this particular page, mastertrader.com/spread trader, you see our 2 credit spread courses. We have a 5-module one, and then a very detailed 12-module one. We find trades every single day, and these are easier to find because we're just calling a short-term top or bottom. On a directional setup, I want a compelling setup as if I were to buy the stock, but I'm just buying options instead. And Don again asked, hey, what do I do more of? And it's because the in-the-money options are often not very liquid, whereas selling the out-of-the-money credit spreads are tighter. So here's an offer we put together for you. You can you got 20% off of that directional course. You get this free kickstart with options for free. And then the weekly options letter, which is the 10 days or less. You can read about that there too.
That spread trader link has it's got directionals as well as credit spreads. But any of those courses are 20% off. That coupon will work on any of them. And then you can, if you wanted to buy, say, the directional and add the mastering, there's an option there. I believe that you can add it. So if you decide to do that, when you enter that option code, options 20, it'll discount both of the courses. So just to make that clear, that code is universal. So whatever checkout you go to, whatever you're going to purchase or add, it'll discount that other than the letter. And the quick start or kickstart options that course is free right now.
All right, awesome. Let's take a look at the markets here and we can review anything people like. I got a few on my watch list here, both for directionals and put spreads. We've done a few this morning already. Greg, you mentioned a couple of great retailers. The solar sector's moving.
Yeah. What I noticed when the markets just got whippy in the morning, a lot of things went up, like 5-minute charts blasted up, and then they came down, and the retailers just hung up there with their wide range bars. Don, the options letter, the weekly options is just selling credit spreads. The advisory letter does credit spreads a little longer in time as well as directional. The weekly options letter does not do directional option trades, just credit spreads. Rohit's asking you what's delta averaging. I think that's just averaging down, or right, because you could average down, average up. You're adding deltas, meaning you're more exposure in the direction that you're deciding. If I'm saying that right, Dan.
Well, I don't know about averaging deltas. That doesn't. Delta just measures how directionally exposed you are. So if somebody says, hey, I'm getting more bullish here, I want to add some long deltas. Well, you do that by either buying stock, because that's a delta of 1.0, or you buy calls, or you sell puts. Those are all going to increase your total delta. But, we don't use brain damage like that. We start with a chart. Everything starts with a chart. What's my bias? And then I teach how to make money directionally in selling options with that bias and how to manage in between.
Right. So this page here, I've got different layouts. When you become a member through a letter or purchase as a student, if you use this platform, which we don't have any affiliation with, so we don't get any money if you sign up. We really don't care. But we think it's great for scanning. It's what we use. So we share layouts and scans. So this particular layout here, this will refresh every minute or so. It just tells me what's active during the trading day. So there was a lot more filling in here earlier in the day because markets are more active as the middle of the day becomes less active. So these are relatively active. And so just to show you, then it links here to the option table. So you can go in and look at that. And then there's different ETFs here. These are, this will change the stocks that are in that ETF. These are some internals. And then here, these are having surges in volume. So scans help us find out what's moving during the trading day. So this is one of the pages. And so I just clicked on this one, it's moving. So what we're seeing today is there's a lot of stuff that's making a turn. So as we look at those patterns, and these are the four markets, I look at 5-minute charts intraday, what's happening in the markets. But we see a lot of stocks that are turning. Even look at this one, Dan.
I just wrote it down. I like snow. Yeah, both. Yeah. So here's how I would do this one myself. If it closes strong, I will sell a put spread, provided it's liquid and I get good premium and go through my checklist, no pending news. And then tomorrow over today's high, I will, so as Don and I were talking a little bit, you can just buy a long call. But since this one's not an all-out bullish setup for me because of the way it came down and so forth, Don, this one I would definitely do a bull call debit spread because I'm willing to give up some upside by making my investment cheaper. But I wouldn't do it today. I like some of your retailers better and the solar stocks better. But that's how I would trade this one.
Just to show you the price of these options, just clicks it and shows the price of that option. I picked an at the money option, 175. Now, these are going to expire at the end of the week, so you better be right immediately so we can go out to next week. So we're going to do this directionally and pick the 175. I'm going to pay $7. We can get in between there. We might pay $6.90, but you can see how it moves with the underlying. It went up as this did, and then it pulled back. It did, and you can even, of course, look at this. Right? If you're going to trade them intraday, let's just look at a 15-minute chart, and you can see how it moves. This has just been chopping around here today, but you can see how the option kind of just chops around, just like the underlying did. And that, when they're at the money as this is. Right, 170. Right, this is a 175 call expiring in 9 days, and you can see it pretty much moves with the stock. So stock 174, option $106.85. It's a little small there. So you can see on the option table how you're getting out of the money. They get less expensive. So one of the things we could do. Right. Again, what Greek this is called, I have no idea. But say like this closes green, it looks great, right? And we say, okay, I think it's going to go up over the next 9 days. Well, the 174 or the 175s, as you saw the price, right? $6, let's call it $6.80. Well, if I think it can go up, well, what if I could buy the 177s or the 180s, and that's almost $2 less. And you can see it moves pretty much the same way, but as it gets, I'm going to buy a less expensive one. And I don't know, Dan, this would show me what the delta is, but I don't really care. I just know, is it at the money or is it out of the money? I know it's close to at the money, and this is a little out of the money. But if I'm right on the direction of this is going to be at the money and then ideally in the money, all right? And it's going to be a profitable trade. So buying the option on a pullback here, the stock is pulled back, and we have a pattern where, look at the pivot, it's creating support, There were buyers there on the dip toward it, and now it's closing positively. Now the question is, does it stay this way? Because it's almost 1 o'clock. And if it closes that way, you could be bought on the close, or as Dan said, wait for it to take out the high tomorrow. We make sure there's no earnings coming out. Earnings aren't coming out until December, so that's clear. And that's a trade setup. And we'll see how it works out. Does it close well today? And then does it start moving up tomorrow? You can see the markets here. I can switch them all. So you can see the markets have pulled back to support. It's pretty choppy and erratic. But you can see they're all at their or close to their support levels, and they're trying to make a turn. In addition, look how far this pulled back, and look at this stock showing relative strength. So it's a lot stronger than the broader markets. And if the markets are going to move up, theoretically, this should not only move up, it should outperform. And so there's a trade setup. And so we can look at others. I can see Amazon's pulled back a lot. That's probably be better for a put spread. Then you just look to see how far away, you can get. So I just simply look at the option table and say, well, that's just not juicy enough to do something even for 2 days, because I would want to sell something down below here to get far enough away. And there's no premium to go out there. But we haven't even talked about open interest. We can get into that another day, but there would be a lot of support at 120 right there. And okay. Maybe just look at other things, that are pulling back here. You see a lot of stuff that's trying to make a turn. Semiconductors have been pretty weak, continue to be. Back to snow, Tesla. So I wouldn't call some of these no-brainers, but if we could find premium expiring Friday, and Tesla usually would, but now that it's been split again, it doesn't have the premium that it used to. But we'd look for something below here, 260 something, and it's just
right. I call this the juice bar, because I find a pattern I like, and I go look, and I'm like, let there be juice here.
Right. So this 265 is pretty good open interest there, 91 by 93. So sell that and buy, 10 wide or 5 wide. You'd only get 50 cents maybe, or a little bit wider. And, you sell one, right, buy the other, you get the difference in your account. And it's like, okay, will it go down to 265? Well, I guess it could, right? It's not that far away. It's just they don't have the premium there that they used to. Dennis says, do you teach spreads to us when we buy the... Yes, Dennis, that's the whole idea behind the Mastering Credit Spread course. You not only are teaching the spreads, the concept of the spreads, but how to trade them, the management of them. Every course that we provide is very detailed. And then we're available through email, and if you're in the green room, on a real-time basis, answering questions. Right. Marcel was asking about QCOM. Price void. Well, it's got a void below, that's for sure. And it doesn't have a big green bar here. So there are some stocks that are showing relative strength just by the fact that they're wider green bars today, which I can show you some, but this really doesn't have a clear void, as we call it, because it's got this chop here on the 5, and then it's got another, here at 129. And so it's got to get above this 129.5 to really enter this void up above. And for those of you that are wondering, what's a void? It's a word concept that communicates that there's no, in this case, resistance until it reaches this level and or down below. If we turn this to say a 30-minute chart, there's no support down below. Now, if we go back and look at snow and look at how that's set up, it's got an unfilled gap. It's got some chop here. So it's not, what I call a textbook kind of a void. It's got some resistance there. But considering that it's showing relative strength, it should be able to get through that. That's what the patterns create beliefs about what the probabilities are in the future. So based on this showing relative strength to the broader markets, it's at support. It's got this consolidation here. If it trades above here, it may stall here a bit, but it should go through it. And sometimes they surprise you when they just blast off, because all of a sudden these institutions come in aggressively at that time. How often do we do day trades in the green room? Lately, not as much as before, because these prices have been pretty erratic, Don, as you even had mentioned before. So look, one thing you have to understand about trading particular strategies and instruments, they can come in and out of favor based on the market environment. So even swing trades can become very, sparse at certain times. And even credit spreads to some degree, credit spreads we could find almost every single day. But as market environments change, a particular instrument or strategy to that instrument, right, can become less active. And then as the market environment changes, it gets very active again. And psychologically, that could become difficult to accept because you want to do the same thing that was working. Doesn't always work out that way. So that's just the way it is, and if you don't accept it, you're going to get beat up in the markets, and you'll accept it sooner or later. So with that being said, I'm going to end this session. I hope you enjoyed it for an options trading session, which can tend to be a little complicated. I thought it was pretty darn good, Dan.
Awesome. Great.
All right, everybody. We'll be back next week. You can go to the website and under education, scroll to the bottom, and there's links to future MT Live. So we'll talk then.
Thank you for listening to Master
Bye-bye.
Trader Live. If you liked the show, we invite you to share this video on your timeline or tag a friend who wants to learn stock market tips. Stay educated with our free chart of the week, a weekly analysis or lesson sent right to your inbox. We're live every week, and you can subscribe to the channel and press the bell to get alerts. If you've enjoyed the event, please give us a thumbs up. Just visit mastertrader.com. That's mastertrader.com.